RBI has set the target inflation at 4%. However, headline CPI inflation for June moved up above 5% levels after showing a slowdown in past 3 months. Fed Chair Jerome Powell recently expressed his concern that holding interest rates too high for too long could jeopardize economic growth. So, in this light, what is your view on the rate cut expectations from Fed and RBI?
Thanks for the question. So, just for the benefit of viewers, it's the government of India which sets the inflation target and which has set the inflation target for 4%. It's largely RBI's responsibility to maintain interest rates to achieve the same target. So, RBI is really working with the target, not really establishing the target. But to answer the question, see, from compared to India, US is running a very high level of nominal rates if you compare to the long-term trend. So if you look at the last 20 years trend, interest rates in the US at 5.5% are quite high compared to the trend basis. And if you look at the growth trends, that has started to come off. So from a growth inflation dynamic, if you look at US compared to India, there is a considerable view there that interest rate needs to come off. So we believe that the statements made by the Fed chair were quite reasonable, and they also reflect that possibly we have some space for rate cuts in the calendar year 2024, probably starting from September. As far as India is concerned, I think RBI has been quite constructive on India's inflation as well. So they have taken comfort from a very stable and a very moderate core. What RBI has been concerned about in the past as well as currently is the volatility in food prices. So, what RBI has repeatedly and consistently stated is that these one-off food price shocks, although they are one-off in nature, but if you continue to experience a series of one-off food price shocks, they built into your inflation expectations as well as on your actual inflation on the ground. So till they see the comfort on these, food price inflation, probably it will not be a fair strategy or a wise strategy to initiate policy easing. One, those food price shocks are still there. They can continue to be experienced, like we saw in June when tomato, potato, as well as onion prices went up quite sharply. Secondly, India is not running a very high nominal rate compared to its historical trend. So, one, when inflation continues to be high, especially in food prices, when growth continues to be quite strong, when our real rates are still or nominal rates are still quite on the lower side compared to the rest of the world, probably RBI wants to wait for actual data before embarking on monetary easing. So I think both the central banks kind of right in their ways that one is seeing evidence, which is the US Federal Reserve, they are seeing evidence of softening inflation as well as softening growth. RBI is yet to see that evidence of softer inflation or any softening in growth, and that explains their cautious stance. Nevertheless, we think that probably by September, if monsoon continues to pan out in the way it is panning out, food price, could come down, and that should give some comfort to RBI because if you look at, inflation x of food prices, that is quite moderate. In fact, if even if you look at inflation x of vegetables, that's just at 3.5%. So that's a very comfortable and a healthy inflation, which should get corrected in the next 2-3 months.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.